Hello everyone! Kumusta kayong lahat? I hope you're all doing well at the moment. And welcome to another episode of the Fine Lecture series with Katsi Sikat. And so for this episode, pag-usapan natin yung pinaka-ginagamit or the most commonly used fundamental analysis technique that analysts, investors, management use when it comes to analyzing the uh, quantitative performance of a firm. No, we want to know the profitability, the operating efficiency, the liquidity, the solvency, the day-to-day operating efficiency of a firm. So the only way to do that is to use financial statement analysis techniques, or financial analysis techniques, as they say in finance. So let's begin with showing you the different tools and techniques that is being used in this what we call quantitative analysis. Okay, so financial analysis is under the umbrella of quantitative analysis. Okay, so we have graphical presentations, we have regression analysis, common size analysis, and the focus of our discussion would be on the financial ratio analysis. I'm sure some of you have somehow natap na itong topic na ito, but this time we want to go deeper in a way that we can practically apply the concepts on current um, current publicly listed firms in the Philippines. So we would want to pretend as if we are scrutinizing these firms, as if we are really going to invest on these different firms. Okay, so sa graphical presentations, we are just simply going to use financial statement information and translate it to graphical presentation. So this is still a component of the financial analysis techniques. Okay, and then the regression analysis is a statistical method. Okay, it's comparing the relationship of two variables. So, anong kinalaman ng sales and receivables? Anong relationship ng inventory sa sales? So, things like that. So, analysts use regression analysis to see the relationship or the level of comparability of these two variables. And then sa common size analysis, we have two types of common size analysis. We have the vertical and the horizontal analysis. So later, let's review how common size analysis work. And of course, lastly, financial ratio analysis. We have so much to talk about this later. So let's begin with the graphical presentation in financial analysis. As you can see, this is a pie chart, and this is showing the operating profit by geographic segment. So let's just say this is a firm operating in a global scale. So ibig sabihin meron siyang different segments or different, let's just say, marami siyang, how do you term it? Marami siyang, okay, there you go. I found the term. Marami siyang subsidiaries, no, on different parts of the world. Okay. Hirap mag-isip ng term, ano. So, let's just say marami siyang subsidiaries operating in these different continents of the world. Okay. So, as you can see, operating profit, just to remind you, operating profit is also called as operating income. It's also called as EBIT, or the earnings before interest and taxes. This is where your cost of goods sold and your operating expenses is already deducted. Okay, the income coming from your operations. Okay, so without looking at the financial statements, or without looking at the financial reports, this is a simplified information which shows the percentage of operating profit depending on these different continents. As you can see, this is North America, this is Europe and South Pacific, this is Latin America, and Greater Asia and Africa. Okay. Obviously, the biggest share of the pie is coming from the Latin America, which is 38%. So you know that among these four continents, Latin America is, or it showed that it created more operating profits as compared to the other counterparts. Now, as a decision maker, as a potential investor, as the management, the upper management, no, you would ask what happened to Europe or South Pacific. What are we doing wrong? What can we improve? No, same with the Greater Asia and Africa and North America. So you look at this comparison and you would know which of this segment is high performing and low performing. And from there, you can derive information through this very simple yet very substantial graphical presentation. Okay, the reason why I am showing you this is because this is a component or part of the financial statement analysis under still quantitative analysis. Okay, and this one, still, we are projecting the operating profit, but this time it is a horizontal bar chart. So, it is now comparing it by year. Kung napapansin nyo, it's from 2007 to 2011. It's a 5-year graphical presentation of the operating profit of the different segments of this firm, and the x-axis is projecting it in millions of dollars. So as you can see, Latin America has been really consistently performing well in terms of its operating efficiency, because operating profit is the end result of the efficiency of the operations. Ano? So you would know just by looking at the chart which among the segments are slow improvement, steady improvement. So as you can see in Greater Asia or Africa, it has a steady improvement. And here in the Europe or South Pacific segment, it showed a continuous decrease, no? So, yun, ganun lang. Napaka-simpleng presentation, but it already speaks a lot. So, it's important for you guys to understand and how do you create visualizations like this. So, napaka-simple pa lang nito, operating profit. And then the next one is a vertical bar chart. This one is in terms of operating profit margin naman, okay? So if you can still remember, operating profit margin is computed by getting your operating profit divided by your sales, okay? So this time, it's a 2016 first quarter, second quarter, third quarter up until 2011. Okay, so ito naman, operating profit margin. Okay. And this one is an example of a regression analysis. So, ang pinagko-compare dito is the GDP change of a particular country. Kasi hindi naman kinukompute to within a firm. GDP is computed within an economy. So, you would want to know if the changes in your GDP has an impact on your sales growth. So looking at this quadrant or at this illustration, you would know kung nasan yung scatter. This is ano kasi, so it shows that when the economy is doing well, okay, so this is the sales growth. Okay, this is the x-axis. This is the sales growth. And the GDP is the y-axis. So as you can see, kapag ka mababa o nagne-negative yung GDP, although wala pa namang hindi pa naman siya totally like maraming negative. Actually, ito lang. Nung nag-negative 2% yung change sa GDP, talagang there is an impact dun sa sales growth. In fact, yung sales growth nag-negative din. So using regression analysis, these are multiple events. So you would know as a decision maker, there is really a relationship, and yung comparison kasi we're talking of the distance, no? Distance of each factor, or the distance of each answers from each other, and it's measurable in terms of percent, ano? So obviously, nandito tayo sa side na ito. When the GDP change is positive, also the sales growth is positive. Okay? So next is the common size analysis. As I have mentioned a while ago, we have the vertical and the horizontal common size. So for this analysis, okay, you are comparing the performance of a single firm based on the components of the balance sheet or the income statement or the cash flow statement report. Okay. So, siguro mas maganda kung I'm gonna show you an example, no? This is an example of a common size balance sheet. Okay. So, as you can see, it is now, how do you call this? It is now presented into a percentage form. So how do you do that? You simply divide all of your asset components to your total assets. So the total assets will serve as the 100% basis. So dun sa 100%, you would want to know ano yung pinakamalaking component ng total assets mo. So cash, as you can see, is 25%. So whatever the numerator is here, divided by this one, you know that the cash is composed of 25% of the total assets. And then receivables and inventory is 35%. The fixed assets, the net fixed assets is 5%. Okay? And then for the second period, as you can see, just by looking at this common size balance sheet, okay, you know that the receivables went to an increase of, there was an increase to 57%. And then in inventory, there was a decrease of 20%. And as you can see also, the cash decreased to 15%. So meaning, kung titignan mo itong example na ito, there was a surge in the receivables, and there was a decrease in cash and decrease in inventory. So isa lang ibig sabihin nito, napakalaki ng pautang ng firm na to at period number 2, just by looking at this common size balance sheet. And why do we have to do this? It's because you just want to simplify the figures so that you can make decision making more easy. Okay, so the simple the information gets, the precise the decision making would be. Okay, so this is an example of a common size balance sheet. Now, how about horizontal? No, horizontal analysis naman is looking at the percent change. So instead of just after getting the common size balance sheet, after getting this percentage, the horizontal analysis would then be comparing it. Comparing this percent change. Siguro magbigay na lang ako ng example. Okay, para mas maintindihan natin. Alright, so this is an example of a horizontal common size analysis. So after getting the common size balance sheet, which is an example of a vertical analysis, horizontal analysis would then be expanding your analysis in a per year comparison. So as you can see, hindi pa tayo nagko-compare sa kumbaga cross-sectional. Pag sinabi mo kasing cross-sectional analysis, you're going to compare the performance of the firm within you're going to compare the performance of the firm against other firms within the same industry. But this time, it's just a single firm analysis. The only difference is you are comparing it to different years. Okay? So in this case, the base is 100%. Okay? 2008 is the base year. So by the year 2009, ilang percent ang in-increase or decrease ng cash? Okay? And then by 2010, how much is the increase or decrease? So hindi lang naman puro increase ito, pwede rin namang magdi-decrease. Okay? But for this example, no, continuous yung increase in the balance sheet. Actually, ito yung example niya, no? Okay, asa na ba yung example natin dito? Right. So this one is a vertical common size analysis. Ito yung ating example. So kapag kinumpute mo to 400 to 404, no, you're just going to look at the impact of change. Okay? So ilang percent yung change? So from 404 to 408, ilang percent? 408 to 412, ilang percent? 412 to 416, so on and so forth. So you're looking at the percent change per year. So that is the difference of vertical and horizontal analysis. Okay? So, di bale, I'm going to give you a copy of this PowerPoint for you to study the examples. So after computing for the horizontal analysis, after looking into the mathematical equations, like for example, this one is comparing 1997 versus 1996. I know it's a very old comparison, but the thing is, if you see the computation, like for example, the revenue growth to 19%. The receivables increased to 38%. The inventory increased to 58%. Now, as an analyst, you will be asking, why are the receivables growing so much faster as compared to revenue? And then, why is inventory growing so much faster than revenue? Because, at the end of the day, no, cash, not profit is king. Remember, it's what the cash or the inflows is more important than the outflows, right? And yung ang receivables at ang inventory, hindi pa yan magiging cash unless ma-convert sila or ma-convert sila back into cash. So you would want to know bakit napakabagal ng bakit napakalaki ng receivables natin for this quarter or for this period? Bakit napakalaki ng growth ng inventory natin? So you would know there is an inefficiency because your growth in revenue is only 19%, but your receivables and inventory are growing at a faster pace or a bigger pace or bigger percent as compared to your revenue. So bilang isang decision maker, you would already know there is inefficiency when it comes to your turnover of inventory and receivables. So again, we are not focused on the computation. We are focused on answering the whys. Okay, bakit? So sa finance, mas importante na nasasagot mo yung rason kung bakit. So what could be the reason? And you have to answer your top management. You have to answer your investors, your potential investors, why these figures. Okay? So probably napakabagal ng pag-convert ng inventory from raw materials to available goods for sale, or let's just say napaka bagal ng collection ng credit department niyo. So there must be a review in your credit and collection department. There must be a review in your operation. So what could we be doing wrong? So things like that. Ano ba yung mga reason kung bakit naglalag yung ating yung ating deliveries? So from there, you could derive your recommendations or conclusions to the management. Okay, so let's define financial ratios, no? Using these definitions from this slide, okay, uh, it is a mathematical relationship expressed as percentage times or days. Okay. When we say percentage, for sure, we're talking of margins. When we're talking of times, ibig sabihin, gaano karaming beses. How many times? And when we say days, we're literally talking of number of days. But to make the definition of ratios more substantial for you guys, it's for sure at some point in your college life as a finance student, you would see these financial statements very intimidating. So let me just show you some examples of this financial reports that you've been seeing for the past several months. These are very intimidating numbers, especially no kapag ka billions na pinag-uusapan natin. We are evaluating firms with billions worth of financial positions. Okay, so ratios, they actually make the life of analysts more simple. Okay, it makes everything simpler because you don't have to look at these values and see how you can make analysis out of these numbers. So for ratios, it simplifies everything. And no, tinatanggal niya yung biases when it comes to whether you are a million peso company, whether you are a 100 million company or a billion peso company. It minimizes the bias when it comes to evaluating the performances of these firms. Okay? Minsan, kasi iniisip natin, the bigger the value of the firm, the more efficient it operates. So it's not true all of the time. You can prove that using financial ratios. So as you can see, I've used 4 different holding firm companies. So these are all holding firms. JG Summit, the Gokongwei Group, we have the Alliance Global Group or the TAN Group, and also we have the Lucio TAN Group, parehas na TAN. And then we have the George T Group or the T Group. We can make comparisons later while we're going to compute for the financial ratios. Okay, so going back to my discussion, like I said, it facilitates comparisons from the vertical analysis to the horizontal analysis, the graphical presentations. All of this is for the purpose of comparisons. So it's comparing the trends of the firm itself and the trends of other firms across the same industry. And by the way, you cannot compare firms not within the same industry. Kailangan kapag nagko-compare ka, it's t-shirt to t-shirt, pants to pants, shoes to shoes. You can't compare t-shirt to pants and you can't compare t-shirt to rubber shoes or shoes. Okay? So, there you go. It is an expression of one number in relation to another. Yun naman ang purpose kung bakit ka nagsosolve ng ratios, right? And meron tayong kasabihan sa finance. The ultimate goal of financial management is to really maximize the wealth of your shareholders. And looking into financial ratios, you would know how much of your investment goes to the operations of the firm. Okay? So, yung bang kada peso na ininvest ko dito sa kumpanya na to is making profit or making value out of it? Is there a result? So saan napupunta yung ini-invest kong pera dito sa kumpanya na to. So by using financial ratios, you would know kung gaano or saan or yung in terms of efficiency, ano, yung efficiency ng operations ng isang firm, you could already evaluate that just using financial ratios. And lastly, no, ratios are interrelated. You would know later why. Bakit yung bawat isang ratio ay may kwento na kaakibat sa iba pang mga ratios. Okay. So, the common questions, no, that we can derive from computing financial ratios is this one, no? How profitable was company X? This is just an example. How profitable was company X? So the ratio is not the answer, you know, except sometimes on an exam. But this one is not an answer, but rather just an indicator. So when we say indicator, it's just a sign, no? It's just a glimpse. It's just a component. Okay? Indicator lang, hindi siya yung pinakasagot. So, therefore, when we use ratio analysis, we are just simply using it for the purpose of comparison. Okay? Am I doing well at the moment? Am I profitable as compared last year? Am I profitable as compared to 2 years ago? Or how am I growing as a firm as compared 10 years ago? So therefore, the ratio analysis, again, is not an answer, but it is an indicator. So, an indicator, relative. So, pag sinabi mo kasing relative, in relationship or in relation to your activities, your profitability, your liquidity, and solvency. Okay? So, when you ask, gaano ba ka-profitable si company X? Okay? So as you can see, this is past tense, was, no? How profitable was company X? So 15.26%. You would automatically say, 15.26% is a good rating already. Okay? Mataas na to. As compared to negative. Kasi importante pag profit pinag-uusapan is kailangan hindi siya mag-negative. Pero what if company Y is more profitable at ang nakuha niya is 28%. Di ba? So yes, company X is profitable by 15.26%, but as compared to company Y, napakalayo ng agwat. So ibig sabihin, hindi pa rin ganun ka-competitive or hindi pa rin masasabing very much competitive si company X when you start comparing it to other companies. And also, what if 5 years ago, ang profitability ni company X was actually 48%? So, you cannot say na yes, profitable si company X kasi 15.26% siya ngayon, but as compared to 5 years ago, it was at 30%. So again, it's not the answer, but rather than just an indicator. It is just a guide. It is just a glimpse. Okay, so I hope you're getting that point right there. Okay, so from there, if this is an example, like I said, no, if you're gonna compare it from last year, kasi yung kaninang sinabi ko nag-decrease, but this time, if last year was 14.9%, no, and right now at the moment, or this year, it's 15.3%, nagkaroon ng improvement. The profitability of company X has improved. Okay? So, again, interpretation generally involves comparison. So, therefore, ratios are not the answer, but rather just an indicator for analysts to interpret for comparison. Okay? Again, itong mga ratios, they answer the questions of whys. Bakit? Okay? Sabi niya, furthermore, analysis will address the question why. Okay. Kasi ito, hindi niya pa sinasagot bakit eh. It's only through analysis that you can answer the question, why did it increase? Why did it decrease? So, ganun, ano? So, computation is not equal to analysis. We know that in your lower level of finance, we have been computing for financial ratios, but we haven't really analyzed. Now, what are the what are some of the questions that can be answered by ratio analysis? These are the sample questions. So, what aspects of performance are critical to successfully competing in the industry? Okay, you cannot answer this question without any basis. So the basis for this question would be answered by financial ratios. Okay, but definitely when you make an analysis, you answer the questions what, how, and why. Okay. So, next question, how well did the company perform relative to own history and relative to competitors? So, you know, pagka sinagot mo to, you have to present the historical performance of the firm, and then you have to compare it to your competitors. Okay. Next question, why? What caused the performance? Okay, saan ba napunta yung ating long-term assets? How are we dealing with our long-term obligations? Paano ba hinihila ng obligations natin, specifically long-term obligations, yung ating balance sheet? Are we how is our capital structuring at the moment? No? Do we have more do we have a continuous surge of net income that contributes to our retained earnings? How is our spending going in terms of our receivables, our inventories, so forth, so on and so forth. This can actually be answered also by the vertical and horizontal analysis. And another question, does the performance reflect the company's strategy? Okay, ito may kinalaman na to sa management aspect, ano, kasi we're talking of strategy. So if dito na magre-reflect if yung vision, mission, goals, and objectives of the firm is being reflected by the performance as measured by your ratio computations or ratio analysis. Okay, so definitely again, financial ratio is not just computing numbers, but rather sabi niya, it encompasses computations and interpretations, and where practical, directly experience the company's business. Okay. What else? No, sabi ba dito, not every ratio is relevant in every situation. So some ratios are irrelevant for certain companies. Some ratios are redundant. That's very true. Industry-specific ratios can be as important as general financial ratios. And different users and questions such as creditors, investors, focus on different ratios. Okay, mapag-uusapan pa natin ito as we go on with our discussion. So let's just say, for example, there are ratios that are not really substantial kunwari sa property sector as compared sa banking or financial sector. Okay, mas maiintindihan natin yan later on. Okay, and different sources categorize some ratios differently and include different ratios. And differences in accounting standards also can limit comparability. Especially pagka pinag-uusapan na natin yung mga iba-ibang bansa na yung kino-compare natin, yung mas complex na ng mga firms, no, international or global firms. Nagkakatalo-talo tayo sa accounting standards. Even here in the Philippines, kung makikita ninyo, no, the way that firms prepare their financial reports are not standardized, or kumbaga may unique na pagpe-present ng financial reports yung iba't ibang firm. Okay, so it limits the comparability. So you have to make sure that the accounting standards, you have to also read that before doing the comparison if they follow the same accounting standards. Okay, now in a nutshell, or in a bird's eye view, the ratios that we're going to discuss in this episode are categorized into 1, 2, 3, 4, 5. These are major financial ratio categories. We have the activity ratios, the liquidity ratios, the solvency, profitability, and valuation ratios. So, napakarami pa actually categories ng financial ratios, but these are the commonly used. And they are, kumbaga, ito, generally speaking, regardless of the industry, ito talaga yung ginagamit. Okay? When we say activity ratios, these are the day-to-day operations of the firm and how the management uses or how it efficiently use the assets. Okay? And then liquidity ratios, from the word itself, liquid. Okay? We would want to know if, kasi liquidity is the ability of the firm to convert its assets back into cash. But when we say liquidity in finance, or in the aspect of financial ratio analysis, we are focused on the short-term obligations. So, is there enough current assets to cover your current liabilities? Okay? So, these are the liquidity ratios. While the solvency, kung titignan natin, ano lang naman kumbaga, liquidity and solvency are both talking about utang. Okay? But solvency, on the other hand, is talking of long-term obligations. Okay? So, liquidity is short-term, solvency is for long-term obligations. While profitability ratios are assessing or gauging the level of profit that the firm is generating. And we know napakaraming profit ang pinag-uusapan, from the gross profit to the operating profit to your net income. So, yan yung mga commonly used profitability ratios. Okay, and then the last, I think this one is something new to you, the valuation ratios. Okay, ito yung usually nakikita nyo sa mga websites like Yahoo Finance, like Bloomberg, or ano pa ba? ph.investing.com. So, ito yung mga lumilitaw dun sa kanilang website, yung mga valuation ratios. So, let's look into that as we go on with the discussion. Now, let's talk about these different categories one by one. So, let's begin with the activity ratios. It is measuring, or it measures how efficient the firm's operations and the firm's management use of its assets. Okay, so definitely when we talk about activity ratios, it's the day-to-day operations of the firm. Okay, when you say activity, day-to-day operations, and these ratios measure the operating efficiency. So if the firm is spending the money of the shareholders wisely in terms of its operations, so it answers the question, how efficiently is the firm using its assets? How many dollars of sales was the firm able to generate from each dollar of assets? So for example, so sa madaling salita, for every 1 peso or $1 of sale, how much of your assets contributed to that sale? Okay? And so, like I said in my previous discussion, if you are opening a store, and the reason kung bakit gusto mong mag-expand ng and if you would wish to expand your operations, hindi pwedeng mag-i-expand ang firm mo without adding additional equipment, without adding additional capital. And so the reason that you would want to add equipment, you would want to add land, or you would want to add buildings, you would want to add additional business venture, is for you to eventually see the effect of these investments in terms of assets, in terms of equity, back to your sales. So therefore, if you are investing and if you're investing all of these assets and it is not being converted into sales, you know that your assets are not being maximized. And so, using all of these ratios under activity ratios, there would be an interpretation to these ratios. So ano daw? Low or declining ratios could mean, okay, sales are very sluggish. There is a heavy investment in assets, pero it is very inefficiently used. Yes, your assets are there, but they are not being maximized into full potential, no? Probably, there should be a plant or plant modernization, no? There should be a strategy shift and the asset mix change, no? Specifically for fixed assets. And it can actually be computed for any category of assets. So these activity ratios are very much applicable to any category of assets. So therefore, the example of this assets, no, this is your numerator and this is your denominator. Pinapakita ko lang to because this is a bird's eye view. Pero let me show you how it works as an equation. So as you can see, no, there is your numerator and there is your denominator. So when we look at ratios, there is always a point of comparison. So this, for this particular ratio, we call it the inventory turnover. You are comparing your cost of goods sold to your average inventory. Because, you know, eventually, your cost of goods sold, no, this is the expense. Kasi this is an expense. This account is found on the income statement while the inventory is found on the balance sheet. So you are now comparing if the cost that you're incurring in creating your inventory is very much efficient in terms of the inventory that you are able to create. Okay? Kasi ang binibenta mo is your inventory, this is your cost. So are you maximizing the cost that you're incurring in your cost of goods sold back to your inventory or translating it to inventory? So using this ratio, no, your numerator is your cost of goods sold, your denominator is your average inventory. This simple ratio would already answer how many times did your inventory, how many times your inventory was created and sold during the period. So, ibig sabihin, pag sinabi mong turnover, this is the efficiency of putting your assets to work. And you know, kapag ka mas maraming beses nagto-turnover yung inventory mo in a period, ibig sabihin you're selling faster. That's why kanina, dun sa ating kabilang slide, pagka mababa yung turnout ng activity ratio mo, definitely your sales is sluggish. So although wala namang sales dito sa inventory turnover, but definitely when there is a slow turnaround or turnover of your inventory, you are not producing enough. And when you are not producing enough, you cannot sell enough. Correct? So therefore, sa inventory turnover, the higher the ratio is, the higher the not profitability. It's more of the efficiency, work efficiency. So let's just say the answer for this one is 7 times. So ibig sabihin, in a year, 7 times mong napapaikot yung inventory mo. But what if yung kabilang firm, si firm B, so your firm A, you have 7 times inventory turnover, firm B has 13 times. So what does that mean? So ibig sabihin, as compared to firm B, mas sluggish pa rin yung inventory turnover mo. You can still improve, you have to keep up to make sure that your investors are satisfied with your performance in terms of converting your cost of goods sold to your inventory. Next, we have the receivables turnover. The receivables turnover answer the question how many times account receivables are created and collected during the period. Okay? Again, how many times accounts receivable are created and collected during the period? Most of the time, this is the challenge for firms, converting their receivables back into cash. No? So again, sa receivables turnover, the higher the turnover is, the better. It only means napakabilis mag-collect ng receivables, or let's just say very effective yung credit and collection policies ng firm. And then total asset turnover, you have your total revenue or your total sales divided by your average total assets. As you can see, this is your sales, right? And this is your average total assets. This is a big deal na ratio. Why? Because you're not just talking of your current assets. You're not just talking of your long-term assets. This is your total assets. Ibig sabihin, ito na yung dugot pawis ng firm. This is the reason kung bakit ka nag-i-expect ng mataas na turnover sa revenue. If your total assets is not being contributed back into your sales, then there must be something wrong with how you manage your assets, right? So, if your total assets is able to convert more inflows or more revenue for your firm, ibig sabihin, the firm is really doing its job to efficiently maximize its assets. And lastly, working capital turnover. Remember, your working capital is computed by subtracting your total current assets to your total current liabilities. So that would be your working capital. So total revenue divided by average working capital. As you can see, lahat ng nandito sa ating equations, they are all average. They're all in average. It's because you have to, the formula for getting the average amount is just simply adding your base year to your current year divided by 2. So if that is 2015 and 2016, you're getting the average inventory. You simply add the inventory for the ending period of 2015 and then add the ending period of 2016 and then divide it into 2, you will get your average amount. Okay, now that you understand how the equation works, we are just simply going to look into a bird's eye view of how the other ratios actually look like and how do you compute for them. So aside from the earlier mentioned ratios under activity ratios, we also have the fixed asset turnover ratio. So as you can see, yung common numerator nila is yung sales, because at the end of the day, what we want to know is the firm converting enough all of its assets back into sales or revenue? Kasi if not, then your asset is a waste. You would rather not purchase your asset if it's not being used at its highest potential. So like for example, you bought your computer, you bought your tablet, bumili ka nga ng desktop PC, but at the end of the day, is your gadget transforming your performance into a high grade? So definitely, ang gauge natin is yung grades ninyo. Kasi kahit gaano pa kaganda yung gadgets ninyo, that's your asset. If it's not being converted back into your grade as your performance, ibig sabihin you're not maximizing the use of your asset. Diba? So, ganun din dito sa ating activity ratios. All of our assets is being compared to the level of revenue or sales. Okay? So, dito sa fixed asset turnover, you are only comparing your sales versus your average net fixed assets. So, we're only talking of your long-term assets. Okay? So, other activity ratios that are used is this one. We have the days of inventory on hand. So meaning this is the number of days. The numerator is number of days in period over inventory turnover. So as mentioned a while ago, other ratios are really interrelated. So this is an example of that because you have to compute first for your inventory turnover before mo ma-compute yung days of inventory on hand. Okay, so this one, ang sagot dito will be instead of times, kasi pagka turnover pinag-uusapan ilang beses. So whenever you see the word turnover, the answer would always be times. And then when there is days of inventory, like this one, days of sales outstanding, the answer would be days or number of days. Okay? And then we have receivables turnover. I think na-mention ito a while ago, ano? The receivables turnover is your revenue divided by your average receivables. Okay? Days of sales outstanding naman, ito naman, number of days bago mo ma-convert or ma-collect yung receivables mo. Dito naman sa days of inventory, how many days mo hawak yung isang, kumbaga, sa isang period, how many days? So, kung yung 7 times kanina, ilang araw sa isang taon, we're talking of specific number of days, no? And then, payables turnover is your purchases. You know, purchases is under your cost of goods sold, no? Purchases over average trade payables. And what else? Number of days of payables, napakarami, no? Very specific. Hindi naman sa lahat ng industry ginagamit itong mga activity ratios na to. Some are very very selected few na talagang very substantial. Ibig sabihin, kailangan mo talaga siyang malaman. But not everything is being required, ano? But what we are just trying to show to you is these are all examples of activity ratios as well. Okay? And since we're talking of day-to-day operations, dito rin papasok yung tinatawag nating cash conversion cycle. Ito, dinidiscuss ko din to under under credit and collection management because we're talking of credit, utang. Kailangan din kasi to very crucial sa decision making if ano lang yung pinaka-ceiling days na pwedeng kumbaga, in terms of liquidity and solvency, hindi mag-aalanganin yung firm dun sa number of days na ini-extend niya yung credit niya. So, pwede mo ring pagbasihan to ng sagot, yung cash conversion cycle. So, the cash cycle answers the question, how long does it take for the firm to go from cash to cash? Remember kasi, cash net profit is king sa finance. That's why, you would really want to know how long does it take when you invest your cash into, so when you convert your cash into your day-to-day activities, no? How long can you convert that cash back into the firm? Okay? So alam mo naman, ang sagot dyan is, of course, the faster the better, di ba? So there is a different cash cycle sa bawat industry. So if you are a service company, ito yung pinakasimple. You just simply sell your service and then you receive back your cash. While in merchandising, pag ito yung mga nagre-retail lang, you buy your inventory, you sell your inventory, you receive cash and pay for the inventory. While in a manufacturing company, you buy your raw materials and then you make your product. You have to sell your product and then in return, you receive your cash and pay for materials and labor. So as you can see, it takes longer for a manufacturing company to convert back its cash into cash as compared to merchandising and service. So basically, pag cash cycle, we are just looking for the number of days. Okay? So cash conversion cycle or the net operating cycle is equal to your day of sales outstanding plus days inventory held minus number of days of payables. So again, sabi ko nga kanina, for some firm, hindi naman nila ito nire-require. Okay? But for the sake of computing for your cash conversion cycle, you have to take note of this 3. 1, 2, and 3. So in short, pagka na-compute mo na itong mga ratio na to, you could automatically compute for your cash conversion cycle. And madalas sa mga quiz B, ito yung hindi nagmimintis na kasama sa mga questions, Okay, kasi ang haba kasi ng formula. Just imagine 3 ratios. Okay? So, this is the closest link to liquidity. Syempre, when we're talking of activity ratios, these are common day-to-day short-term activities. So, pag sinabi nating liquidity, meeting your short-term obligations. So, you have to compute for your cash conversion cycle to know whether the firm is very much liquid or not. Okay? Working capital, as in current assets minus your current liabilities, reflect the investment required to support this cycle. So again, dito na yung tinatawag na pag sinabi kasi nating support, we're talking of leverage, or do you need extra funding? Do you need extra financing for you to cover your working capital? Syempre, as a manager, you would want na yung funding mo would come from your own assets as much as possible, na hindi nakakailanganin ng utang. So, para malaman mo yon, you have to compute for your cash conversion cycle. Okay? So, days sales outstanding plus days inventory held less number of days of payables. Okay? Now, next is your liquidity ratios. Okay? So, liquidity ratios are short-term obligations. So, ano yung commonly used liquidity ratios? We have the current ratio, we have the quick ratio, and the cash ratio. So, for the current ratio, napakasimple lang. You just simply divide your current assets to your current liabilities. So, meaning, kung ako ay isang creditor, okay? Kung ako ay nagpapautang, and I would want to know kung itong lumalapit sa akin na firm, they would want to apply for a loan. The first thing that I would look into is their liquidity ratios. So again, sabi nga kanina dun sa ating introductory part, there are certain parties, not other parties, external parties. So let's just say creditor. So aside from the supplier, you have your investors, you also have your creditors. Mas magfo-focus ako dito sa liquidity ratios as compared to the activity ratios. Kasi ang purpose ko is to extend loan. Okay? So let's see. Current ratio, no? I have an example of JG Summit, Alliance Global, LT Group, and GT Capital. We would want to know how much or what is their current ratio. Pero balikan muna natin yung slides natin, no? Okay, current assets over current liabilities. I-apply natin yan dito. We have the current asset and current liabilities of JG Summit. Just so we can we know kung ano yung kanilang current ratio. So let's just give an example. Okay, siguro dito na lang. Okay. We have all right. Okay, for JG Summit, let's compute. So that would be your current assets. So as you can see, this is it. Current assets divided by current liabilities. So current assets. Okay. So this is for year 2017 and 2018. 2000 dito na lang sa baba. Okay, dito na lang. Ba't ba pinahihirapan ko yung sarili ko? Okay, this is going to be for 2018 divided by your current liabilities. There you go. And then this one. So, Okay. Okay, from this answer, you would know that as compared to 2017, no, mas liquid si JG Summit as compared to 2018. So, for every 1 peso of current liability, merong 1.14 na current asset. So, for every 1 peso of current obligation, you have 1.14 of asset to cover your obligation. So, in short, the higher the ratio, actually, pagka current ratio pinag-uusapan, at least 1 para maging siyang 1:1. So, for every 1 current obligation, you have 1 current asset to finance that obligation. That's why the higher your current ratio is, the more liquid the firm is. Now, let's see. Tingnan naman natin kung cross-sectional comparison. Okay, for Alliance Global, let's see. Okay, then this one. Okay, LT Group. Right. Next, we have GT Capital. Okay, as you can see, no, mas maliit yung value nito kasi they have, this is in millions. Okay, it's not in thousand, it's in millions. They just simplified their financial reports para mas madaling mabasa ng mga investors. Okay, so let's make a quick comparison lang, ano? Okay. Last. Okay. Itong si Alliance Global, no, this is in billion. Like I said kanina, tinatanggal niya yung bias that regardless if you are a million peso firm, if you are a 100 million firm, or if you are a billion peso firm, if you look into the ratio, nawawala yung ganung degree of bias o when you evaluate the firms, ano? So what's important is the ratio, okay? The ratio that it projects. So as you can see, kung titignan natin, the most liquid firm, without looking into the amount of money invested in their assets and liabilities, it's a close fight, no? It's a close fight for GT Capital and Alliance Global. Although in terms of capital, in terms of assets, mas kokonte kasi million lang to, 129 million as compared to the billion that the Alliance Global has. Okay, so we know that both Alliance Global and GT Capital are very much liquid as compared to their other holding firms, such as JG Summit, no, 0.93 and 1.14. LT Group is really struggling with its liquidity. You know why? Because LT Group, sa kanya ang Philippine Airlines, and you know the airline industry is very much napakalaki ng demand for short-term assets kasi yung operations ng airline is very much expensive as compared to other industries, no? Kaya struggling talaga in terms of liquidity ang LT Group. So as you can see, this is how you actually use the ratios, no? Mas madaling mag-interpret ng data because it's very much simplified. So you know that Alliance Global, GT Capital is very much competitive because of a higher liquidity ratio. So this is just an example. No, current ratio is just an example of the many ratios that you would encounter in our discussion. So aside from current ratio, no, very much commonly used din yung quick ratio. The reason why it's called quick ratio, because you only take into consideration part of your current assets that are kumbaga, as compared to other components of your current assets, ito talaga yung mabilis ma-convert back into cash. Because, you know, wala dito yung inventory, and other short period assets. Kasi ang reason kung bakit kinukompute ito is if we discount the presence of your inventory dun sa computation, will your quick ratio still be able to finance your current liabilities? So, quick ratio is stronger than current ratio in a sense that most of the time, yung percentage ng inventory talaga sa current assets is very high. And yung inventory ang pinakamahirap i-convert back into cash. So, again, quick ratio is more stronger. Kumbaga, kung ako yung creditor, mas kailangan kong tignan yung kakayahan ng firm na magbayad pa rin on time kung sakali man, like for example, ngayon that we are in a pandemic, no? Mas mabagal talaga yung pag-convert ng inventory kasi mabagal yung commercial activity ng mga tao. We're not purchasing that much or not going out of the house. So, napaka-importante na makita mo bilang isang analyst if merong bang kakayahan yung firm na makapagbayad pa rin kung tatanggalin mo yung pinaka mabagal na current asset na may kakayahang bumalik or ma-convert back into cash. That's why ina-add lang yung cash, short-term marketable investments, and yung account receivables divided by, of course, your current liabilities. And sa cash ratio naman, no, kung sa quick ratio tinatanggal mo yung inventory, dito naman pati yung accounts receivable dinidiscount mo na rin or tinatanggal mo sa equation. This is the most liquid ratio simply because it's the cash ratio. You just simply look into how liquid the firm is in terms of the level of cash that it possesses at that period. So it's just simply cash plus short-term marketable investment. So these are the commonly used liquidity ratios. Okay, next we have the solvency ratios. So we have the debt ratios. Okay, so how has the company financed itself? Now we have the debt ratios and then the coverage ratio. So the first one is the debt to total assets, and then we have the debt to equity and then debt to total capital. Okay, ang sinasabi dito, the lower the ratio is, the safer. Why? Because when the firm is exposed to so much debt, you know what happens, di ba? Based on the 2008 financial crisis, the firms were very much exposed to debt without their investors knowing, no? The tendency is when you are exposed to more debt, you are exposed to more risk. So the safest way to finance a firm is to have more funding from its owners and less funding from debt. So as much as possible, if a firm can kumbaga effectively manage its debt, the better. Kaya yung ating ratios dito when it comes to solvency ratios, we need reasonable level of debt. So you can see that by computing a lower ratio, sana yung dilitaw, ano? Next, sa coverage ratios, we have the EBIT interest coverage and the fixed charge coverage. What is that? It's your earnings before taxes plus your interest payments divided by your interest payments. Sa fixed charge naman, this is only applicable for firms who have lease payments. So kung wala namang lease payments yung yung firm, this one is no longer needed to be computed. Okay? So, ang pinagkaiba ng debt ratio sa coverage ratio is there enough earnings or cash flow coming from the firm, no, to show, parang pinapakita lang netong ratios na to kung meron bang abilidad na magbayad ng interest yung firm. Okay? And then, okay, so this is a summary of the common solvency ratios. So this is the numerator and the denominator. So debt to asset ratio is your total debt divided by total assets. So sa madaling salita, you're just simply looking at ilang percent ng total assets mo ang funded by debt. So whether that is short-term or long-term, how much of your total assets or ilang percent ng total assets mo ang nagfi-finance ay utang. Ngayon, kung ang total assets mo is 60% financed by debt, nako, medyo ano na yun, delikado. As much as possible, sana 50% lang, no, kalahati. So, pag lumagpas na yan ng 75%, nako, talagang delikado na yung debt to asset ratio ng firm. And then, debt to capital ratio is your total debt plus your total shareholders' equity versus your total debt. Okay, so in short, this is your total liabilities and total shareholders' equity being divided by your total debt. Or sorry, your total debt divided by your total liabilities and shareholders' equity. Next is your debt to equity ratio. This is your total debt over, hindi nakasama yung liabilities mo, just the total shareholders' equity. And lastly is the financial leverage ratio. This is your average total assets divided by your average total equity. So this time, it's your assets divided by your equity. So hindi po ano ha, there is a difference between your equity lang versus your total shareholders equity. Makikita nyo yan dun sa financial statement. Okay? And then for the coverage ratios, we have your EBIT divided by your interest payments. And then fixed charge coverage is your EBIT. Kanina kasi EBT, di ba? Earnings before taxes. So simply, kapag in-add mo yung interest, EBIT na yon. Shortcut lang niya. So same lang. Just get your EBIT and then divide it to your interest payments. And then that's it for the common solvency ratios. Since we're talking about returns at the moment, pinag-uusapan na rin naman natin yung returns. If you are a potential investor and you're very much interested to invest in a firm, or you are already an investor, one of the ratios that you would want to look into is the return on equity, because this is the percentage or it's like a figure that lets you know how much are you going to earn when you invest in this particular firm. So, syempre, it affirms that a firm is really profitable when the firm is able to give back the profitability to its shareholders. Kasi ang formula niya ay net income over the average shareholders' equity. You know that when your net income is high, your average shareholders' equity is high, your return on equity will be considerably high as well. So, it's the overall package of knowing how profitable it is for the part of the shareholder or the investor. Now, speaking of returns, there is what we call the DuPont analysis. Okay, so this DuPont analysis was actually formed by the DuPont company in the 1920s. So, pinapakita lang or dinadissect lang nitong formula na to yung changes na nangyayari dun sa pinaka most important factors on the increase and decrease on the ROE, since it's the most important ratio that investors look into. So, itong DuPont formula, dinadissect niya yung total asset turnover, yung financial leverage or yung tinatawag nating equity multiplier, and yung net profit margin. So, these are the three major components of the increase and decrease on the ROE. Okay, so furthermore, dinagdagan pa ng additional factors. So aside from the total asset turnover, the financial leverage, pinapakita din ng DuPont formula yung changes sa ROE coming from the operating profit margin, from the non-operating items, and lastly is the presence of tax. Okay? Lahat ng name-mention dito is merong gross effect sa ROE. Okay? Basically, you just want to see yung pinaka-reason kung bakit nagkakaroon ng changes sa ROE. Okay? That's why, pag dinisect mo yung DuPont model, it has parang 5, 1, 2, 3, 4, 5 different ratios in one equation. Because this one, total assets over shareholders' equity is your financial leverage ratio. Okay? How much of your total assets is financed by your shareholders? Okay? So this is your leverage. And then we have here revenue over total assets. This is the formula for return on assets. Okay? Operating income divided by revenue is your operating profit margin. And then this one has something to do with the effects of non-operating items and your tax effect. So this is five ratios dissected to get one ratio, which is your return on equity. Okay, so yun lang naman ang ibig sabihin ng DuPont model. But this one is most of the time also included with so many quiz B questions kasi nga sa haba ng formula niya at kailangan mo siyang i-memorize, palagi siyang included sa mga quiz B. So ang usually tanong, compute for the ROE using the DuPont model. So you have to use this formula as compared to this formula, return on equity na net income over average shareholders equity. So yan lang yung formula on a shortcut basis, but using the DuPont method, you're taking into consideration total asset turnover, financial leverage, net profit margin, and other factors that has something to do with tax and your non-operating items. Okay? So para lang siyang pinagsama-samang ratios into one. And usually, ang nakukompute na ROE using DuPont model is higher. But for decision makers kasi, like for example, dito na lang sa leverage natin. When the firm is kung yung asset, no, kung yung total asset mo is financed by debt, yes, tataas yung profit margin mo, but definitely it's very risky. So one way of knowing what contributed to the ROE is very much important. That's why they were able to formulate this equation so that yung return on equity computation is more precise or more comprehensive. Okay, so this is the formula for that. Okay, we are now on our last category of ratios, which is the valuation ratios. Okay, the word value is very much associated with the word price. But in finance, value is more important than the word price because value is something that is earned over time that has wala siyang directly kinalaman sa price, as in yung nakikita yung price sa mga websites ng PSE, ano, value is associated with growth. And Warren Buffett is suggesting that we go for value investing. Okay? So value investing means looking for cheaper stocks that that have high earnings potential. Ibig sabihin, you're looking for the underdogs. You're looking for uh, yung mga tinatawag nating glamorous stocks, no? Kasi nandun pa lang sila dun sa growth stage. So before pa mangyari yung booming, kailangan meron ka ng share dun sa potential na yon. So with valuation ratios, this is the part where investors can see if a particular stock is undervalued or overvalued. Okay. Pag sinabi mo kasing undervalued, no, it's selling cheap right now for the big potential it has in the future. But when you say overvalued, it is selling extremely, hindi naman extremely, it's selling very expensive as compared to its earnings potential. So, syempre, ang sinasabi natin palagi, substance over form. You'd go for the substance. That's why, dito sa valuation ratios, you are looking at the earnings of the firm. And at the same time, you are comparing it to the price that it has at the moment. Okay? So, basically, napaka-importante ng valuation ratios for investors. Okay? So if the liquidity ratio is very much important for creditors, no, solvency ratios are also very much tawag dito, it's very substantial for suppliers as well as creditors as well. Yung activity ratios is very much substantial for upper management, for decision making. And profitability ratios are also equally important for management and the investors. While the valuation ratios is very much important both for the management and the investors, pero mas mabigat pagdating sa mga investors because this is the point where they decide if they are willing to shell out their financial resource, if they are willing to entrust their money to this particular firm. Okay? Kasi naman, ang pinag-uusapan talaga natin is the earning potential and the current market price. And by the way, if you're wondering, paano ba yung basis? Saan ba nagbe-base yung stock price na nakikita natin na nagfa-flash sa stock market? Sa madaling salita, if we're going to explain it in layman's term, the stock price is the window to the firm. So meaning, the value of the firm is being reflected on the stock price. So the higher the value of the firm in terms of assets, right? So habang lumalaki yung assets ng firm, lumalaki din yung market price ng isang firm. And that is why increase in price would also mean increase in value of the firm. Okay? But sometimes kasi, there is what we call, ito pinag-uusapan to sa behavioral finance, ano? Sometimes, the behavior of investors, nagkakaroon tayo nung tinatawag nating law of supply and demand. The more demand that there is in a particular stock, the higher the prices would go up. Kumbaga, kapag ka mas marami yung demand kaysa supply, tumataas talaga yung price. And the other way naman, no, kapag ka bumababa yung demand, maraming supply, bumababa yung price. So, ang sinasabi natin, you have to look for the intrinsic value of the stock and disregard the market activity. Ano? But that's how the game is played, eh. That's how the stock market makes it very much exciting for traders and investors. But anyway, going back to the valuation ratios, these are the commonly ratios that are being shown sa mga websites. You will see earnings per share, you would see PE or price to earnings per share, you have your book value per share. So pag-usapan muna natin itong earnings per share. So ang sinasabi lang, no, magkano yung kinikita, magkano yung potential earnings kada isang share na bibilin mo sa isang firm. So, if you are buying a 1 peso share, okay, how much is the earnings that you will derive from that single share? Okay? So, kumbaga, it's a figure that can give you, kumbaga, it doesn't have to be, a complicated figure. Just by seeing the earnings per share, you know how much are you going to get for every 1 peso of share that you invest. So, syempre, kung earnings ang pinag-uusapan mo, the higher the earnings per share, the better, right? Kasi ang computation niya is net income available to common shareholders divided by the number of common shares outstanding. But in some cases or in some references, weighted average ng common shares ang hinahanap, no? But for a simpler computation, total number of common shares outstanding, which is usually available naman sa mga websites, you can see, no, numbers of share outstanding. So pwede mo nang makompute. But also, this is readily available, kinukompute na kaagad ng firm kasi ganun siya ka-importante. So definitely, pag pinag-uusapan na natin ang earnings per share, the higher, the better. Now, after earnings per share, let's talk about the price to earnings ratio. Kasi ito yung pinaka commonly used talaga na valuation ratio. So, this is the ratio of the price per share of equity to the earnings per share. Sa madaling salita, this is the amount that you're willing to buy for a corresponding earnings of a firm. Okay, dito mo malalaman kung overvalued ba or undervalued yung shares na binibili mo. So to make our what do you call this, discussion more meaningful, so nandito ko ngayon sa pesolab.com. This is a 2009 as of October 2009, this is the blue chip companies ng Philippines na gusto ko lang ipakita yung price, earnings per share, and then the price to earning ratio. Okay. Siguro anin na lang natin itong sino bang magandang saan ba si Ayala? Okay. So, Ayala right here is selling at 849.5. Okay, this is the price of Ayala Corporation. Now, the earnings per share, ibig sabihin for every share that you buy, it has an earning potential of 83.5. Just imagine. So, per share, meron siyang kakayahang mag-earn ng 83.5. So, tignan nyo naman as compared to the other blue chip stocks, napakalayo ng difference, if you try to look at LT Group, Semirara, napakalayo. Except for Globe, comparable siya with PLDT, but the rest are relatively low. So if you're looking for stocks that you would want to invest in, you'd go for higher earnings per share. Okay? So totoo naman, Ayala Corporation, you would know that these companies are really profitable kasi ang computation natin for EPS is net income Net income attributable to common shareholders divided by total number of shares. So they are really profitable as compared to other similar blue chip stocks. But dito papasok yung importance ng price to earnings ratio. So, ibig sabihin ng price to earnings ratio, how much, okay, how much should the investor be willing to shell out for a 1 peso earning. Okay? So, as you can see here, we have siguro mamili ako ng Okay. Sige, si Aboitis na lang. Okay? Kung makikita ninyo, ang kanyang earnings per share ay 2.88. So, nakakapag-produce siya ng 2.88 na earnings. And are you willing to shell out 12.81 for a 1 peso of earnings? So, ibig sabihin, ito yung sinasabi nating, yes, this is the price, this is the stock price, but this is the price that is related to your earnings. Uulitin ko, for you to avail of a 1 peso earning, you have to shell out 12.81. So, you know, napakamahal ng isang share para sa isang 1 peso earning. Okay? So, as compared mo dito kay PLDT, same. Halos parehas na sa 12, nasa range of 12, pero yung earnings niya ay 89. Okay? So, kung kukompare natin si PLDT at Aboitiz, they have the same price to earnings per share, pero napakalaki ng earnings ni PLDT. Are you willing to pay 12.81 for a 1 peso of share na ang kaya niyang ma-generate is 2.88 versus a price, yes, magbabayad ka nga ng 12.25, pero ang earnings niya would be 89.33. So, kung ito ang pagbabasehan natin, it's better to invest in PLDT as compared to Aboitiz. But here's the deal. Look at this, Globe Telecom. Price to earnings is only price to earnings is only 11.76, meaning this is cheaper. No? You're only shelling out 11.76 as compared to the 12.25 for an earning which is significantly higher as compared to PLDT. Okay? So, the point is, ang sinasabi nila, the lower the PE is, the better. Ibig sabihin parang sinasabi na undervalued yung stock if the price to earnings is very low but the earnings is significantly high. So you know that this is a good buy. It's a good stock. Okay? Pero tingnan nyo naman kung gaano kamahal ang isang stock ng Globe, no? 1,768. So, kung titignan natin yung mga cheaper stocks, eto, napakalayo ng presyo. Okay? 4.78 per share. Okay, as compared to the 1,768. You are only buying 4.78. Pero kung titignan natin yung price to earnings ratio niya, you know, it's yung earning per share niya is only 0.42, ang layo sa 150, no? Pero tingnan nyo gano'ng ka-close yung price to earnings ng price to earnings ratio ng Metro Pacific. 11.38 versus 11.76. Halos magkalapit lang. You are willing to shell out 11.38 to get a 1 peso earnings of Metro Pacific Investment Corporation? You be the judge. Dun ka ba sa 0.42 o dun sa 150.3? Halos same, no? 11.38, 11.76. So you know that this is an overvalued stock sa lagay na yan, ano? Hindi sulit yung babayaran mong 4.78 for this kind of earning. So, ang point is, you go for a higher EPS with a lower price to earnings per share. So, ganun ka-valuable yung ating tinatawag na mga valuation ratio. So, I hope that made sense, ano? So, aside from that, we also have what we call the diluted earnings per share. Wala namang pinagkaiba yung numerator niya because the net income available to common shareholders is simply getting your net income and then subtracting your preferred dividends. Okay? So same lang naman dito, net income less your preferred dividends divided by the number of shares outstanding, considering the only difference is you are considering dilutive securities. So when you say dilutive securities, the word dilute means gawing malabnaw. Okay? Diba pag nagdi-dilute ka ng solution, nilalagyan mo ng tubig so para mas mawala yung tapang. So pag sinabi mo kasing dilutive securities, we're talking of warrants, we're talking of options, we're talking of convertible debt, no? So unlike ito, average common shares outstanding, we're talking of all of the common shares outstanding lang. Dito, hindi ko kasi yung the number of shares outstanding can be changed in any time of the year. Okay? So, kasama na doon yung mga dilutive securities. So, outstanding shares plus the warrants plus the options plus the convertible debt. Okay? So, pero madalas pinapakita pa rin naman ito sa mga financial reports, both earnings per share and diluted earnings per share. Now, ang pinagkaiba ng book value per share sa hindi pala pinagkaiba. Ang pinapakita lang dito is the difference of the current price. Kasi pag sinabi mong current stock price, the price at which the stock is selling at the stock market. But when we say book value, this is the value of the stock in the books of the firm. Okay? So, the book value per share is simply the book value of equity divided by the number of shares. So, ito makikita to sa balance sheet ng firm. Okay. Next, we also have ratios for dividends. So, we have the dividends per share, we have the dividend payout ratio, and then we have the plowback ratio. Okay. Ito yung sinasabi ko kanina, sometimes yung formula, weighted average number of shares, ano. But, sa exam ninyo, wala naman akong ipapakompute sa inyo na weighted average. Most of the time, dun lang tayo sa total number of shares outstanding. Okay? So, dividends per share is simply the dividends paid to your shareholders divided by the weighted average number of ordinary shares outstanding. And then, dividend payout ratio is the dividends paid to common shareholders divided by the net income attributable to common shares. So, this is exclusively for the common shareholders. And then the plowback ratio is the dividend payout ratio. Just to make sense of all of this ratio, siguro tignan na lang natin itong problem. Pinapakompute yung ating book value per share. And then we have the price to earnings, then we have the dividends per share, dividend payout, and plowback ratio. Siguro without computing this, let's look at the let's look at the answer. Okay, so the book value per share is $1. So it only means that the book value, if we're looking at the book value of the equity, ibig sabihin this is the amount of total equity that is stated on the balance sheet. The value of the share is $1. Now, if the stock price is $3, it's selling at $3, you know that the $3 is very much expensive. Okay? So, ang gagawin mo ngayon, hihintayin mong bumaba dun sa book value yung price. Because you know, the $3 is not the real value of the share. You always have to base the real value on the book value. Kasi yan yung without bias coming from the market, without the bias of yung law of supply and demand. So this is the book value per share coming from the financial statement of the firm. Now, like I said kanina, price to earnings ratio is for every $1 that you shell out, for you are going to shell out 16.67 for $1 of earnings. So just imagine, you're going to for you to avail of the $1 earning, you have to shell out 16.67. Okay, so the market price of the stock is 16.67 times earnings per share. Okay, so magiging valuable lang itong number na to if you try to compare it to similar firms within the same industry. So if this is 16.67 but the other firms are only selling at 14 or 13, this is very expensive. Pero kapag itong 16.67 compared to the peer group or the other firms within the industry, kung siya ay 20, 21, this is cheaper. So kailangan talaga meron siyang point of comparison or else the answer would be meaningless. Now, for the dividends per share, you are going to receive 0.12 or kumbaga nag-shell out ng $0.12 yung firm na dividends per share. And then the dividend payout ratio, it only means that 40% of the earnings of the firm was distributed in the form of dividends. Okay? So, dun sa total earnings, 40% ay pinambayad ng dividends. While sa flowback ratio naman, this is the proportion of earnings retained by the company. So, totoo naman, 40 plus 60, that's 100%. So, 40% dinistribute as dividend, 60% na-retain ng company. Okay, so so far, yun ang ating napag-usapan sa valuation ratio. So this is very much important on the side of the investors. Okay, to conclude the discussion for this episode, let me just remind you the beauty of using financial ratio analysis. And of course, syempre, there are also limitations in using the financial ratio analysis because you have to be very careful kung saan mo kinu-compare yung firm, no? You have to be very much careful if they're in the same accounting standards, they have the same business cycle, they sell the same product, or they're almost at the same level of operations. So, the thing is, you are looking into which companies can you best subscribe your shares. Kumbaga, the question is this, how would I know kung saan ko pwedeng i-invest yung pera ko? How would I know kung sinong firm ang pinaka may efficient na operations? Sino sa mga firms ang pinaka profitable? Okay? So, it all boils down to the point of comparison. Okay? So, financial ratios are not used for the sake of computing the profitability alone, computing for the efficiency alone. It only makes sense if you make it comparable. Okay? And aside from that, financial ratios are also used to forecast the future performance of the firm. Kasi kung meron ka ng basis, like for example, 2010 as compared to 2020, 10 years ang pagitan, have we increased in value or did we decrease in value? Or in the next 10 years, if we provide this kind of strategy, would our ROE increase to 10%? No? I remember si Ayala Corporation in 2015, they launched the 2020 vision. So, nung 2015, they had this vision of increasing their profits by 20% starting 2015. So, these are strategies that alongside with this ratio analysis and other financial statement analysis techniques, you can make sure that you are in the right path. Okay? You know that you can gauge the performance of the firm. So it's kung makikita mo naman sa financial reports kung napanindigan nga nila yung 2020 vision, ano, but unfortunately the pandemic happened. So for sure something, may mga changes or may mga tweaks dun sa mga planong or mga strategy na was already predetermined before the pandemic happened. So anyway, it's a good way of knowing that as a future investor, as a future analyst, you can easily answer these things. Or siguro para mas makita niyo yung beauty ng pinag-usapan natin dito sa episode na to. Let me just share with you this comparison among Ayala, SM Investment, and JG Summit. So these are all holding firms as well. So as you can see here sa website ng phinvesting.com, makikita mo yung current stock price ng firm. Okay? And you can see the ratios that are available, no? Umpisahan na lang natin dito sa price to earnings ratio. Kung makikita nyo, merong TTM, no? Ang ibig sabihin nito, trailing for 12 months. So this is a 1 year, it's a 1 year ratio or value. It's a computation good for 1 year. Tapos ito, the most recent quarter. So this is, ito yung pinaka-latest. So quarterly to. And then we have, meron pa yung 5 year. 5 years. So yun ang ibig sabihin. Naka-indicate naman, ano. So the point is, I just want to let you know that all of the ratios that we've talked about are ratios that are really commonly used by practicing investors or actual investors, no? Like this one, the PE ratio, the price to book ratio. Also, there is price to sales. Simply you just divide it by the current stock price to the sales, no? Ganun lang naman. Tapos cash flow. Although it was not mentioned, but it's also used, no? But the point is, okay? The point is, these are all available online. Hindi nyo na nga kailangan mag-compute kasi nandito na siya. So we have here gross margin, profit margin. We have the operating profit margin, pre-tax margin, then the net profit margin. As you can see, meron na din siyang kasamang graphical presentations all throughout in a 5-year average margins. So you could also see here. All right. Okay. May idea ka na without even looking at it. Around 26% nga naman. So 26%. Kukompare natin yan mamaya dun sa dalawa. Let's see kung sino yung mas profitable sa kanila. What else? We have the profitability ratios pa rin to, no? Revenue per share. As you can see, nandito yung basic EPS, diluted EPS, book value per share. And then we have management effectiveness. Ito, yung mga return on equity, return on assets, return on investments. Now that you understand kung ano yung equation ng mga to, you could easily understand what they mean, ano? And then we have the quick ratio, current ratio, asset turnover, inventory turnover, revenue to employee. Meron pang ganito, no? Net income per employee or net income to employee, receivable turnover. So ito mga commonly used. So sabi ko nga kanina, hindi lahat ng mga na-mention nating ratios ginagamit talaga and pinopost sa mga website. So yung iba na hindi na-mention dito, those are purely for management purposes or kumbaga for creditors, for suppliers, but not really for the interest of investors. So itong mga nakapost dito are for the interest of usually for the interest of investors. So let's try to look on the return on equity. This is Ayala. Tingnan nga natin yung sa SM. Return on equity. So let's see. ROE 6.95. This is for 12 months. Okay? Tingnan natin si ano. 8.28 si Ayala, 6.95 si SM, si JG Summit naman, ay dapat pala, tama, JG Summit kasi is Robinsons. So yung mga malalaking mall developers natin. Okay, asa na si ROE? So 3.01%. So obviously, kung itong website na to ang pagbabasihan natin, Ayala Corporation is the most profitable in terms of ROE. How about liquidity? Let's see kung ang quick ratio ni Ayala is 1.21. Si SM Investment ay 0.76. Yep. JG Summit is 0.72. So obviously, no, si Ayala Corporation pa rin ang pinaka-liquid among the group. How about asset turnover? Tignan lang natin kung talagang consistent, no? From the ROE to the quick ratio, let's see if, sige, how about inventory turnover? Inventory turnover is for Ayala Corporation is 1.11 times in a year. While ito si SM naman ay dito siya medyo mas mabilis, ano, 3.6 times siya nagto-turnover ng inventory in a year, while JG Summit is 2.24. So in that case, medyo kolelat si Ayala. So mabagal sa pag-convert ng inventory. How about receivable turnover? Ito yung mga pautang. So 1.36 si Ayala. Ito, mas mabilis ang turnover ni SM and mas mabilis din si JG Summit. Okay, so kung makikita nyo, in terms of comparison talaga, you can't say na perfect talaga in all aspects. So kung makakita ka ng firm na sa lahat ng categories ng ratios talagang number 1 siya all throughout or consistently siyang high performing, you know that it's a good it's a very stable firm. Okay? Pero syempre si Ayala, hindi naman siya bumababa sa 1. Ibig sabihin, reasonably competitive but not as much as competitive as the others pagdating sa efficiency. And of course, syempre, napaka-importante din ng ng profitability ratio. So tignan natin yung net profit margin dito tayo sa latest 1 year, no? So si Ayala ay 12.61. So tignan natin si SM Investment. Net profit margin niya is 9.62 SM. JG Summit is net profit margin 5.75. 5.75, 9. So, pinakamataas pa rin si Ayala. Okay, 12.61. Papatunayan natin yan dito sa ating price to earnings. Asan na ba yun? Kasi ito tama, price to earnings ratio. How much? Siyempre, dyan mo makikita kung mahal ba o mura yung stock dito sa price to earnings ratio. How much are you willing to shell out for a 1 peso earning of the firm? So the PE ratio, hanap tayo yung mas cheap. Tingnan natin kung mas mababa ba. Okay? So the price to earnings ratio of Ayala is 19.34. SM is, nako, ang mahal, 47.34. As compared to the industry, tingnan nyo, ito yung peer group kasi, no? 26 ang mahal. Ang mahal ni SM, 47.34. And si JG Summit naman is mas mahal, 60. Okay? So kung titingnan mo, very promising si Ayala, pero napakababa nung kanyang price to earnings ratio. Ibig sabihin, Ayala Corporation is a good buy. Kung titignan mo yung performance niya, kung dun sa kanyang net profit margin based on the yung kanyang profitability, yung ROE niya, kung dun pa lang pagbabasehan, you know that Ayala Corporation is really a good company. Given that the PE ratio is very, very low as compared to its other counterparts, Ayala Corporation is really a good uh, it's a good buy as compared to SM and JG Summit, given that they are all equally established and they are all blue chip stocks. No, dito sa list na ginawa natin, Ayala is surely a good buy. So if you're considering to invest in the future, siguro first choice nyo would be Ayala Corporation. Okay, that ends up our discussion for this episode. I hope marami kayong natutunan. It's a good discussion kasi you can really use it for future use, and it's a common language that finance majors are using and will be using in their work as professionals. So maraming salamat for finishing this video and joining me with this discussion.